What is up, everybody? Steve here. I came across on Mortgage News Daily a really good article that explained mortgage-backed securities really well. So I'm going to read off of this article. I'll throw in some cool B-roll for you guys so you guys don't look at this mug the entire time. I'm just reading this. But I want to get this out so people have a better understanding of what mortgage-backed securities are. Mortgage-backed securities are bonds that mortgage loans are turned into when they are bought or sold. For example, Big Bank will write a check to your mortgage company. Say it's $100,000. Big Bank A then has a promissory note saying you'll pay them a certain interest over time. But Big Bank A needs some more money to lend to other people. They can then sell your mortgage note to someone else in the form of a bond. Hopefully that investor is willing to pay something like $102,000 for the right to collect interest on your $100,000 loan. Big Bank A just made a $2,000 spread, and the investor has something that they will hopefully pay them interest over time. If the investor is only going to pay $97,000 for the loan, that means Big Bank has to pay them a discount to buy it, which was probably passed on to you on line 802, which is the good faith estimate. Essentially, it's a fee that you're going to pay upfront at the time of the loan. But there's a big problem. The investor doesn't want all of the risk riding on one loan, so we have to find a way to spread out the risk. Because even if you have a 3% chance of defaulting, in the event that you do, the investor will lose his hat. So to spread out the risk, Big Bank A combines your loan with tens to hundreds of other similar loans with similar rates and similar credit quality. Then either by selling them directly to Fannie Mae and Freddie Mac, or by utilizing Fannie and Freddie's protocols and doing it themselves, Big Bank A accomplished what is known as securitization. Now the pool, which is the collective of all bundled loans, which will now be in the millions of dollars, can be broken down into bond-sized chunks. Now instead of buying one loan for $100,000, give or take, an investor can buy a portion of tens to hundreds of loans for the same amount of money, with the same rate of return, with the same risk of default. But now if you apply the 3% rate of default, the investor only loses 3%. And it's a concept that has allowed a significantly larger amount of money to be available for home loans than ever before. Now, what a lot of people don't understand is during the pandemic, the Fed was buying up to $40 billion worth of mortgage-backed securities every single month, which in turn allowed more and more banks to lend more and more money, which assisted in getting us into the housing trouble that we're in today. Now, if you've never seen the movie The Big Short, it's a really good movie, and I highly encourage you guys to watch it because it shows you what exactly happened with mortgage-backed securities back in the last real estate recession and how manipulated things got. Anyway, I hope you guys got a better understanding on what mortgage-backed securities are. And if you're not a subscriber, I talk about everything pertaining to the real estate market, the housing market, what's going on, any updates going on, because I want you guys to be first to know of everything that's on the internet that I'm bringing to the table. So if you're not a subscriber, consider it. If you are a subscriber, I appreciate you guys being here once again, and I'll see you guys on the next video. Thanks for being here.